Hello everyone, welcome back. This is module 6 of capital investment. In this module, we are covering risks in capital budgeting. This is the final lecture of this module, and in this lecture, we will cover risks adjusted discount rates. Now, let's look at what does it mean by risks adjusted discount rate. In general, risks adjusted discount rate is the rate of return that a firm must earn on its projects to compensate the firm's owner's investment adequately and to maintain or improve the firm's share price. So, the higher the risk of a project, the higher will be the risk adjusted discount rate, or simply RADR, and the lower a project's net present value. So this is how we can find NPV of a project using risk adjusted discount rate. Now let's review the capital asset pricing model. We know that total risk is equal to non-diversifiable risk and diversifiable risk. In case of investment, we only consider non-diversifiable risks because diversifiable risks can be eliminated through diversification of investment. So the non-diversifiable risks can be measured using capital asset pricing model. So which is equal to which can be also used to find out the required rate of return or risk adjusted discount rate based on the risk-free rate plus beta of the project into RM indicates the market return, RF again indicates the risk-free rate. So this formula can be adjusted to find out required rate of return for a particular project like project Z. Here RF is the risk-free rate, then beta of the project Z, then RM, which is same for all projects, and RF should be also same for all projects. So once again, RJ indicates required rate of return on asset J, RF risk-free rate, BJ beta coefficient for asset J, RM is the return on the market portfolio of assets. Now let's look at how we can apply risk adjusted discount rate. Suppose Benefit company wishes to apply the risk adjusted discount rate approach to determine whether to implement project A or project B. So the Benefit company's management assigned a risk index of 1.6 to project A and 1 to project B, and the required rates of return associated with this index are applied as discount rates to the projects to determine NPV. So based on the risk index, which is 1 for project B, required rate of return for project B is 11%, and required rate of return of project A is 14%, which is based on the risk index of 1.6 for project A. Now these are the initial investment and cash flows of project A and project B. So based on the risk adjusted discount rate, which is 14% for project A, NPV of project A is $6,063, and based on the risk adjusted discount rate of project B, which is 11%, NPV of project B is 9,798. So based on the risk adjusted discount rate for both projects and based on the cash flows of these projects, we can say that project B is better than project A because NPV of project B is much higher than the NPV of project A. So there could be different risk classes based on the riskiness of the project. Say for example, for a below average risk projects, so this indicates projects with low risk typically involve routine replacement without renewal of existing activities. A risk adjusted discount rate is 8%. For the second risk class, the average risks are the projects similar to those currently implemented, and typically these projects involve replacement or renewal of existing activities. And for average risk projects, risk adjusted discount rate is 10%. Then risk class 3, above average risk. This is the projects with higher than normal but not excessive risks. Typically, these projects involve expansion of existing or similar activities. And for this sort of project, that means above average risk adjusted discount rate is 14%. And finally, risk class 4, highest risk. So these projects are the projects with very high risk, typically involve expansion into new or unfamiliar activity. So for risk class 4, risk adjusted discount rate is 20%. Now let's consider risk adjusted discount rate in case of portfolio. So we know that individual investors must hold diversified portfolios because they are not rewarded for assuming diversifiable risks, and business firm can be viewed as portfolio of assets. So it would look like that it is also important for the businesses to hold diversified portfolio. But in reality, from the research and empirical evidence, it is found that firm value is not affected by diversification. In other words, diversification is not normally rewarded and therefore is generally not necessary for the firm. However, the diversification is necessary for individual investors. So it turns out that firms are not rewarded for diversifications because investors can do so by themselves, and investors can diversify more readily, easily, and costlessly simply by holding portfolio of stocks. So firms are usually do not require to diversify their investment, and firms are not rewarded for diversification. And but an investor can diversify easily, rapidly, and costlessly. So that's the end of module 6. In our module 7, we'll cover capital structure.